to our virtual roundtable here, where we are going to be talking about how to use your sector expertise for business development purposes. And we want to explore that topic because, as you all know, the M&A market is becoming increasingly sliced by industry vertical. And I suppose now you can even argue by industry sub-vertical. We're seeing both buyers and sellers become really good at getting to know their few key target industries as opposed to the generalist strategy, which doesn't necessarily offer the same level of depth. But what we're not seeing is M&A advisors and private equity firms always use that industry knowledge in how they're reaching prospects, whether that be a new client on the sell side or a new LP if you're in private equity. But before we begin, allow me to quickly introduce myself. I'm Nick Donato. I'm an industry specialist here at Navitar, which provides cloud software to manage your deals, investors, and clients. And I'm joined here today by 3 deal specialists who are finding new ways to use that industry knowledge of specific sectors to enhance relationships with both, again, prospects and current clients. In fact, one of our speakers told me already just recently that his bank is becoming something more of an information broker in his target industries as opposed to just your traditional investment bank. All 3 of our speakers will introduce themselves shortly. Before that, I want to quickly get through some housekeeping. If you have any questions, in fact, I encourage you to submit questions. We'll be happy to field them at the end of our discussion, which, as your moderator, I'm going to try to keep to around 30 minutes or so. Just use the GoToWebinar widget tool that should be on your screen there. And also, only because this comes up a lot, yes, a recording of today's broadcast will be emailed out to everybody, so just look for that in your inbox in the coming days, I'm going to say. I should mention, too, that all 3 of our speakers are Navitar clients, so if we move on to the next slide here, I can give you some background on us. Navitar is the leading cloud software provider that is wholly focused on the private capital markets. But what we have done is built out a platform that can manage your investors, clients, deals, and portfolio. We are the leaders in our space. We have with over 600 customers across 35 countries. And in the context of today's webinar, I should mention too that we have developed a number of business development tools and workflows that make it easier for you to segment your prospects by industry and really just tailor your messaging. I believe our speakers will touch on some of those points, so I may bring in our COO, Kate Kankar, who is with us here today, to show what some of those points look like from a visual perspective. Before all that, let's meet our roundtable. I'm joined here today by Clint Bundy of Bundy Group, an M&A advisor, Alex Koles of Evolve Capital, also an M&A advisor, and Brian Weisenberger, who's going to be our
a nearly 30-year-old boutique investment bank, family-owned investment bank based in Charlotte, North Carolina, and Roanoke, Virginia. $100 million or under, and I'm looking forward to participating in the webinar today.
Thanks, Clint. And then if we could move on to Alex.
Yes, thank you. Hi, I'm Alex Koles, the CEO and Managing Director and founder of Evolve Capital Partners. We're a New York-based specialized investment bank. We focus exclusively on companies at the intersection of finance and technology, more fintech than anything. Typically, our clients have enterprise values of about $30 million and above. And, we have a global reach across the broader fintech space across the world.
And Brian?
Thanks, Nick. I am the executive director at Ascendant Capital, focused on product development and due diligence. Ascendant is actually the exclusive capital markets and client services group for GPB Capital. GPB is a $1.4 billion alternative asset management firm that's focused on acquiring profitable cash flowing businesses in mature industries and then providing income generating solutions to investors. So GPB focuses primarily in a few select industries, including automotive retail, waste management, managed IT services, and healthcare.
Thanks to all of you. And I've been thinking about this, the best way to set the table here. And what I would think makes sense to kick off our conversation would be to first to define what it means to be a specialist today. We know that this is an ongoing trend. It's been increasing over the years. But if you could all provide some perspective on what exactly constitutes a specialist in today's deal market, I think it would help provide some perspective. Clint, let's start with you.
Yeah, thanks, Nick. You know, I think in terms of what I've seen in the market is that over the past, call it 5 to 10 years, you've seen this kind of corporate investment banking mentality of industry specialization kind of permeate down in the middle and the lower middle markets. And I think the way I would characterize it today is to be a specialist, you have to have some niches or industries that your firm knows well and where your name carries, or else you're really just a commodity. For our firm, you know, we've got certain parts of healthcare services, controls and automation, transportation and logistics that we have spent a great deal of time investing our energy into and building our name in. And kind of to your point of, are there firms out there that mischaracterize themselves as specialists? My answer to that would be yes, there are, but I think business owners are much more keen and smarter today and can sift through quickly.
Clint, you know, I guess in defense, in some aspects of generalists, you know, a lot of you know, qualified CEOs, boards, management teams are going to see right through to your understanding of the ecosystem. So for example, we focus on essentially fintech types of companies. And a lot of our clients, you know, they sell into financial institutions, and, you know, just understanding that ecosystem cold as an example, who they sell to, how they price, contract terms, et cetera. That gives us, you know, a really strong advantage when it comes to selling or financing the company, because we understand the ecosystem. And I think boards, CEOs, owners are very attuned to that in today's market.
I think this is Brian. The only other thing I would add to that, and we're a little different because we're obviously on the private equity and asset management side, is that we focus and specialize really in two different directions. So on the investment side, we've identified very specific industries and then identified a thesis around how we expect to and intend to invest in those industries, usually through an aggregation strategy across those industries. But we've also specialized on the other end of the spectrum, which is we provide very specific and specialized investment solutions for our limited partners entering our funds. So we structure investments that take advantage of the unique qualities of the industries we're investing in, and namely, we provide an income solution through our private equity investing to investors. So we're really specializing in each direction.
If I could ask the roundtable too, because with this increasing specialization trend, something that I had mentioned during the intro was that we are now seeing more M&A advisors and private equity firms go down into sub-verticals. So you may no longer be a healthcare specialist, you may be a pharmaceutical specialist, that things are becoming even more refined. Your feedback or your advice on just how refined things should go.
Yeah, this is Brian. I can speak to that. You know, it sort of depends on the industry for us. Automotive retail, where we acquire car dealerships, is not one where there's a sub-specialization. You actually want to have the diversification across all the different manufacturers, whereas we do have a vertical investing in managed IT services companies, and we've drilled in very specifically to a niche of the managed IT services industry in which we focus on healthcare-related companies that have certain types of protection and requirements around electronic healthcare records, HIPAA requirements. So that's been to our advantage from an acquisition perspective. It makes it easier for us to identify very specific attributes of companies we want to acquire and manage, afforded by just buying, generalist IT companies.
As a investment banker, being very, very, very specialized is a double-edged sword. One, you do a broader net. So as an example, within one of our areas of coverage, payments, that's a very large area, but you can drill down very deep into payments. It's massive. There's international remittance, you have networks, stuff like that. We like to keep it a little bit higher at the more broad level where we can specialize or jump into different areas within payments and kind of pivot across that, broader payment space, at least, from the banking perspective for our purposes.
And building on that point, also becoming a specialist, no matter how refined you get, whatever speed limits you want to impose, speaking circuit every now and again. Could you give us some insight on what it means to leverage those opportunities as a specialist?
Is providing newsletters of M&A and capital raise activity. It's developing the relationships with executive directors of state and national conferences who recognize us as kind of being the go-to resource. Willing to stay in front of those executive directors and what have you to get on the speaking circuit. But we've certainly seen a huge jump in our ability.
The general strategy, because I know that many of you have seen it from both sides, what it means to reach your prospects working at a generalist firm or bank, as well as this newer specialist route. So Alex, if we were to start with you, let's talk about what it means to market as a generalist, to define the old school way of doing things.
Yeah, I think, that's a good question. And I really haven't been, a generalist in my life, but I'll go to a time in my professional career when I was a generalist, but I had a very specialized product. And that's when I did restructurings for large companies from about 08 till about 11 or 12. We were generalists in nature, but we, again, like I said, very specialized product. So we would chase a whole host of industries and a whole host of private equity funds, a whole host of debt investors. And what I found challenging and hard about that is you always had a 75,000-foot view of the industry. You could always reference some transactions that your firm had worked on. Thankfully, we had a large bench and a large set of transactions at BDO. But really coming in and being able to speak about specific deals, the rationale, the actors in those deals, the valuations, it was very, very challenging. And I found it more difficult to market to our clients as a generalist in that case. And oftentimes we would go pitch against a specialist who also had restructuring experience, the same product as we had. And oftentimes if it was a, let's say it's a retailer, it was a specialist in the retail space who had a specialization in restructuring, that would more often than not go to them. So I found that we had a great product, big bench, a lot of experience, but kind of all over the place. I found that to be a little bit harder to educate our potential clients and really have, as Clint had mentioned initially, that open exchange of information and kind of having this two-way street. It was more like we would show up and hope we could get something, but not give as much back to them during the exchange. And that was very frustrating. And that really opened my eye, personally.
This is Clint. I'll just add that, many moons ago when we Bundy Group would have defined ourselves as a generalist, I think what I would say is that our trend of going from a generalist to more of a specialist follows the same arc of this sort of growth in the information age and the aggregation age, and frankly, the growth of the sophistication of the business owners. Back when my father started this firm in 1989, and frankly, through most of the 90s and early 2000s, most owners didn't even know what EBITDA was, much less who the best buyers were. And then all of a sudden you have the inflection point of the internet and information sharing and just a higher sophistication degree among the owners, which then in turn the owners pushed the investment bankers to be smarter and to know more. So the pitch that we all as investment bankers have had to change and the specialization we've had to accumulate is as a result of just the increasing awareness and intelligence of the owners out there and CEOs and industry consultants, et cetera.
This is Brian. From my perspective, and I think obviously as a private equity firm, I've got a little different perspective than Clint and Alex, because when I'm talking about marketing, it's really in attracting LPs to our offerings. And we target investors from a very wide range of areas, all the way from high net worth individuals to the largest institutions. But in terms of generalist versus specialist, for us in communicating with those prospects, the difference from my perspective is that I'm not going into a meeting talking about the merits of private equity investing. Generally, it allows me to go a layer deeper and really talk about the specific industries that we're investing in, and again, the thesis that we have as it relates to how we intend to approach that industry. So I think it's a more meaningful conversation, because truthfully, unless you're Carlyle, KKR, or Blackstone, and you can lean on a very long track record, speaking about private equity generally is not enough today without having something more specific to talk about in the industries that we expect to invest in.
Brian, if we could expand on that point too. So now that we've identified the old school way of doing things, and we can jump more into how you are reaching prospects with this specialist mentality, creating a more reciprocal exchange with your prospects. Can you provide any more detail on how you do that at the initial stages of the relationship?
Yeah, I sure can, and it sort of evolved for us. We're a relatively young firm that's grown quite a bit over the last several years. So as we were starting, we were really pointing towards a thesis and towards case studies of how people have executed within our target industries previously. It's now quite shifted to having a track record of having done it. We've acquired over 100 companies as a firm over the last several years, and so we can now again take that conversation even deeper in a meeting and talk about how we are executing on a strategy as opposed to how we intend on executing it. So our meetings tend to be very granular. We point to the actual companies that we are operating and how they're performing, and what our outlook is on the industry and the companies in particular. So it's very hand to hand from that standpoint. We think the best way to approach it from a marketing perspective is to get as detailed as possible.
And then Clint or Alex, same question to you. How, as specialists, how you were creating that initial reciprocal exchange of information with your prospects?
Well, this is Clint. I think from what I'd say from our standpoint is, and I don't think at the end of the day there's any secret sauce here, whether you're a private equity group or an investment bank, you've got to pick the right industry or industries for you based on your research. And you just have to invest in the time to build up your Rolodex and build up your knowledge base, and then figure out how you're going to do the outreach to them. That's to put the plug in for Navatar here. That's where getting organized using a common CRM system that can also help you track deals allows you to kind of build from the ground up and be organized from day one. And you've got to do a lot of the just kind of research that relates to understanding the industry and going to the trade shows and really just a boot on the ground mentality. So I think it's just an investment of time and energy. And full disclosure, while we've got a lot of successes to our credit, we've had one or two failures on the industry investment side, and that happens. And I think it's trial and error. And sometimes it's a lot of error before you figure out what fits from an industry perspective.
This is Alex. I would agree with Clint, 100%. I've come to find over the last, 5 or 6 years that our, fintech expertise, it's highly beneficial because our channels, which I define as investors, conferences, personal relationships, and also through direct marketing, it's a two-way street of sharing information. And again, I have to say, Clint describes it very, very well and hits the head on the nail. To give an example, since mid-May through today, because I track this using the Navatar system, I have personally held about 350 separate meetings all across the globe and here in New York as well too, all over. And a lot of these prospects or existing relationships, they're looking for a flow of information. 249 out of the 250 probably won't result in an immediate transaction, but it's relationship building. And you have to do the basic blocking and tackling, exchanging information, being at conferences, and being that industry participant really to drive that forward.
It's interesting that you say that. Would you guys say that there's any value left in the cold call approach? Is that still even useful, or has the specialist strategy really recommending that initial relationship is either built through that trade show or something else that creates it more of a warm lead?
This is Alex. Can I jump in real quick? Cold calling is very, 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 very difficult. We had one instance where we had a cold call into a prior client, Lease Dimensions, that was ultimately sold to Genpact, but it wasn't cold in a way because Lease Dimensions actually was a client of our client. So we kind of knew of each other, really had never interacted. I had a referral opportunity that was business development related to Lease Dimensions because I had a great reputation. Made a cold call in, passed a business development opportunity off to the management team. That became a piece of business to them, and then we developed a relationship. So, that's kind of a one-off. But I think cold calling, where you're kind of separated maybe, by the second degree, is okay in certain instances where you have some common friends or common business relationships, but otherwise it's very, 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 very difficult.
This is Brian. If I change directions a little bit from what I've been talking about in the past and talk about sort of cold calling on the acquisition target side of things from a private equity perspective, I totally agree. We focus in industries in which we're generally acquiring companies where there are publicly traded competitors in the space. And so, our biggest initiative on that side is to be at trade organizations, conferences, to make our presence known in the space as a firm that specializes in those industries, because very often we're competing against very well-known entities and publicly traded companies that are seeking to acquire similar type companies. So the cold call from that perspective does not work unless it comes with some recognition on the front end. But it's much more helpful for us to have either a referral from an existing acquired company or some recognition through a trade publication or conference.
I agree with both comments made, especially Alex's comment about kind of the second degree call where maybe you don't know each other directly or have been a direct referral, but you've got some common connection to the industry or relationships. I think that to me is not a cold call. So I agree with both comments by Alex and Brian.
And Clint, keeping with you, if we could get your thoughts on just how the market is responding to those initiatives. So we have evolved to a large extent past the cold call. How are prospects responding to these things?
From Bundy Group's perspective, but I think what I would caution anyone who's beginning to analyze and attack what markets or niches to attack is don't expect overnight success. It's about consistency of information, followed by, of course, what really counts, which is successful execution on client engagements. And it's if you think one email or one phone call is going to get you across the goal line with 10 potential clients and get you new engagements, that would be a false sense in most cases. And so I think it's all about the consistency followed with the information provided, and especially the execution of client engagements. And our reception's been really good. Even in the past, call it month, within a couple of our sectors, we've seen our pipeline pick up pretty substantially based on information that we've been sending out through some e-news blasts, as well as some follow-up conversations that we've had and referrals.
Alex or Brian, in terms of how prospects are responding to these new evolved approaches?
Yeah, this is Alex.
Go ahead, Alex.
Go ahead, Brian. Sure. I would say real quick, potential clients, funds, others are responding very well. Now, one thing I have found over the years is that if you are reaching out to the market or to a particular person, company, fund, having some form of rationale, especially if you don't know that person. I'm reaching out because you invested in the XYZ company, and we know another company that could be a good add-on if you're a private equity fund. Or if it's a company, reference a transaction or reference a transaction that you've worked on. So kind of having some rationale as it ties to your space, as it ties to that person you're engaging with, that carries so much weight in my experience, and kind of shows that you're a sector expert. Whereas if you just kind of send out a blast email saying, hey, I'm in town and I'd like to discuss market trends with you, kind of more of the generalist approach, your success rate's going to be a little bit lower. So I'd say these initiatives, kind of from a holistic perspective, they're paying off fantastic. And then,
yeah, not totally unrelated from my perspective is that I'd say, the best success that we have as a private equity firm is word of mouth from the companies that we've acquired. We sort of position ourselves in our industries as partner capital and expansion capital. And so what we tend to see the most success, and where we've seen the most success in approaching new acquisition targets, is when they have some type of knowledge or relationship with someone that we have already engaged with and we've already provided private capital to. And then that experience with that prior acquisition goes head and shoulders above any other information that I can provide them outside of the relationship that they may have with an existing partner of ours.
So we've been talking about how to reach prospects, and it's good to hear that they are responding well. What I'd like to do now is talk the actual execution of those strategies. So what are the actual tools, practices, or technology that you are using to execute on these new best practices? And let's start with you, Alex.
Yeah, we use a whole host of technology, and we just use Navitar exclusively for our CRM and business development tracking, also for deal tracking. It's a great platform. But also from a information or data perspective, I mean, we subscribe to a whole host of newsletters and databases and publications, and a lot of this gets integrated again into the Navitar platform. And this allows us to be very targeted if members of our team are traveling to a certain area, or help manage campaigns with conferences, or again, certain areas that we're tackling, and it keeps us very organized. But again, we supplement it with external data sources such as PitchBook or FactSet or Capital IQ, and having kind of a robust platform here has allowed us to, stay on top of the current market trends, data, new prospects, and existing prospects. So it's kind of it's a holistic approach, because if you're managing all this stuff in an Excel sheet or your Outlook, you're really not allowing yourself to fully disseminate information that you have with the broader marketplace. So it's a really kind of a holistic approach, at least in our experience.
This is Clint. At the risk of making this sound like a Navitar sales commercial, I'm going to second pretty much everything Alex said. For us, our Navitar system is kind of our central nervous system. It is, we're an investment bank, so we don't have equipment or inventory. Our inventory are our relationships, which is where we house them in the Navitar system. So our associates are probably in there in the system many times in an hour, setting up deal rooms, taking notes from meetings that we've had or phone conversations we've had. And I think my best piece of advice, whether it be you're a private equity group or an investment bank, is get organized early using a system like Navitar. I felt like we were ahead of the curve when we set up our Navitar system and kind of started using it appropriately. But the truth is, in hindsight, I probably would have started using it 2 or 3 years even earlier. And I think it would have made a huge difference. So that's from the execution standpoint, it's the Navitar system coupled with, of course, external resources like trade publications and industry relationships and what have you.
I guess we might as well make it a 3 for 3 on the Navitar plug. So at JPB, we're relatively new to the Navitar system, and we're using it for a number of different purposes. But I think from our perspective, the most important is to manage our deal flow and pipeline. We're a little atypical as a private equity firm in that we acquire, unlike most firms that acquire, call it 4 or 5 companies a year, we acquire 2 or 3 companies a month. And so we also deploy that capital and acquire those companies in real time. We raise capital on a monthly basis and we deploy it at the time that we raise it. So we have to keep a very large pipeline of deals across our sectors. As you might imagine, it can range in the 10s to 20 of different companies across each industry at any given time. And so we came to Navitar to really organize that process, and it's been extremely effective for us in maintaining the pipeline, but also then in management reporting and several other factors as it relates to the portfolio companies that we now run.
Well,
Brian,
we do appreciate. Oh, sorry, go ahead.
I was going to say, Brian, that's interesting, and it sounds like you have a lot going on. And kind of on the flip side, to the benefit of the funds or the clients or the investors or the people we're meeting on the other side of the table, especially if we've met with them multiple times over many years, it's really helpful to have one spot where you can pull up past meeting logs, whether if it's input by myself or my analyst or my coworker, and then see what we've communicated with them in the past. So when I walk in the door, I can jog my memory and really pick up that conversation. And just kind of having a decentralized spot is not effective for that, especially if you have multiple people working at your organization. I found that to be so beneficial over the last several years using this system.
This is Clint. I agree with the use of tracking meeting notes, and I'd also add the deal room is key, because I can have a potential client call me at any point and say, can you give me a quick debrief on potential buyers or investors for my firm? And if I've had a deal room up and going and been populating it with private equity groups and strategic buyers, I can turn that information around pretty quickly on a client-specific basis.
And we do appreciate those mentions, because what we are doing is we speak to M&A advisors and private equity firms on an everyday basis, and the entire goal is to develop these new business development workflows to make your own day job easier. And in fact, this also creates a very easy segue for me. What we can do is show you those exact workflows, so we can give you some of the tools that people are using to reach their prospects. I have Kane, who is here with me. Kane, if you could in 5 minutes or less, give us a demonstration of exactly what some of these workflows that we've been talking about here look like visually.
Sure. Thanks, Nick. This is Ketan here, and I think we'll just take a few minutes to illustrate some of these points. A lot of the message that was coming out was being able to have a central place to organize all the information so it can be utilized in a better manner, but also from a business development perspective, to use the information that you have to have more targeted outreach, more targeted communication, so that it reinforces the message around the specialization, the message around kind of the knowledge that you have about specific industries. So a lot of our customers, kind of what they would do is, like in this example, organize from a prospecting perspective, right? All the companies, all the investors, they can categorize them by industry verticals, sub-industries, and they also do tiering, and this allows them to, again, have it in a central place, but then they can have an outreach strategy that is specific to each tier, for example. So how many touch points you want in a month or in a year. So you can have specific strategies, and then even then, when you're doing your outreach, you can have your list of companies that you want to communicate with. When you are communicating with them, it does not have to be a generic communication, right? So you don't want to send a generic email out or a generic newsletter out. You want to have specialized content. And along with that, you want to make sure that you're matching the content to the companies, right? So in this case, once you have a list, instead of sending out a communication to the entire list, if you are specializing in certain industries, it's much easier to just go in there and then say that, hey, since this newsletter or maybe this announcement, maybe we've done a deal, I want to send this deal announcement only to the companies that would care about this deal announcement. So in this case, if it's let's say if it's a technology deal that I did, I can then go down and say, only send this announcement to all the companies that specialize in technology, because again, these are the only companies that would care about an email like this or would care to read that content. So you can filter down based on all the history, based on all the based on all the information that you've gathered, and then make sure that any communication that's going on is catered and tailored towards the content, and you're able to map the content to the audience that you're targeting. So again, this is just a simple example and one of several tools that are available that we thought we could just quickly illustrate. Back to you, Nick. I think we can go into questions.
Yeah, thanks, Kay. And I do think it's important to always give a visual representation of what exactly we're talking about, so that's appreciated. We do have a few questions that are coming in for our panel here. I'm going to keep your names anonymous and paraphrase a bit here, but someone is asking, how do you know when, as a specialist, that you've chosen the wrong sector? How do you know when to call it quits, in other words?
Well, this is Clint Bundy with Bundy Group. Since I'm the one who mentioned that we had a kind of a stub toe or two in the past, I'll take first crack at it. You know, I think a lot of it's just instinct. You know, for us, we kind of, it was back in more like kind of 7-8 years ago, we focused on a subset of let's call it infrastructure and construction. And, we did kind of the trade show circuit a little bit. We certainly had a number of potential client engagements, but, for us, we frankly didn't enjoy the kind of owners that we were working with. We didn't really feel like our efforts were highly valued by that subset of owners. Our market timing probably wasn't great. And ultimately it was just opportunity cost for us. I think if we'd hung in there, we would have seen probably at least a decent uptick in pipeline. But at some point, I think you just have to use the opportunity cost measurement and say, our time and effort is probably better spent elsewhere. And I think it's a month by month or maybe a quarter by quarter judgment, but it's not a week by week judgment. You got to give yourself more time than
that. Brian or Alex, I know it's not the easiest question, but when you've chosen the wrong sector.
This is Alex. To put it bluntly or nicely or directly, it's when you see a lot of unprofitable companies with a lot of bankruptcies and distress situations. We looked at a very specialized area within the specialty finance sector around infrastructure 4, 5, 6 years ago. And it was very, very challenged. And one thing I noticed as well was there was less competition from investment bankers for these situations. I think a sector that has a healthy amount of competition is an indication of a sector that has a lot of transactions and that might be successful or is being successful. But this particular area we were focused on, oftentimes we were just like the only person or the only group that was looking at the opportunity. I think a little bit of competition is a sign that the sector is viewed favorably. If you're the only one there, maybe you found the gold diamond, but otherwise it might be kind of a red flag.
Yeah, that's a good point. We have another question that's coming in. Someone is asking about the type of information or the type of sector analysis that you're including in your deliverables like newsletters. So I guess where you're getting that information and then what type of exact information are you sending?
Sure, this is Alex here. In terms of the information that we do send out, it takes a lot of work to assemble this, and the information sources come from a variety of databases, conferences, proprietary information, but maybe a little bit more important than all of those is we understand the investment themes and the trends within the industry. And through transaction experience and being sector experts in the fintech space, we're able to convey that into our newsletters or monthly roundups and stuff like that. Also, one thing to keep in mind when you do send out materials is if you're in the transaction business like we are, probably the same for our private equity friend here, just discussing comps and valuations or performances, also something you should always convey as well too, because that's what we're probably experts at.
Yeah, this is Clint. I'll just add, I agree with everything Alex said. I think ultimately that it's a boot on the ground effort, and the benefit of being a specialist is it's not just that you get the closed deal announcements in a space, or you get or you get the industry publication that announces trends. But it's most importantly, it's the fact that as a specialist, you should be talking to either strategic buyers, private equity groups, business owners on a weekly basis who are feeding you what their observations are on the industry, which you then in turn can recycle and put at more of a macro level and feed it back to an audience. And I think, that's kind of the benefit of being a specialist is you can do that and provide those summaries and information.
Yeah, this is Brian. I agree 100%. In addition to all those different resources in terms of industry papers and other resources, we work with a number of different investment banks to get more transactional information and understanding of where the industries that we're operating in go to. We've also, in a couple of industries that we operate in, hit a critical mass in which we've got a number of different companies in which, from an investor reporting perspective, we're able to transition from not just providing industry data from generalist sources, but also provide a lot more detailed information about the actual portfolio companies that we own and operate. And so we can compare and contrast as to what our portfolio companies are doing compared to what the overall trends in the marketplace are, which I think has provided a lot of value add.
We have another question that's come in here. Someone's asking for tips or best practices for increasing the response rate for when you're reaching out to a privately held business in the mid-markets. So I'm guessing this is slightly related to the cold call approach, or how you first begin that relationship, if anyone wants to field that one.
I think this.
Alex,
yeah,
go
Alex,
ahead.
This is cool. I'll take first shot at Alex
okay.
and follow up.
Okay. Great.
I think this goes back to, again, not a secret sauce. It's just the consistency of following up, but following up with information, setting up meetings at common events like industry trade shows, and just keep feeding them information either by email, letter, scheduled phone call, and the consistency more times than not on these kind of warm calls, let's call them, that consistency will usually yield a decent success rate. I'm not saying you're going to bat 1,000, but I think that's the best approach I would know to take. Alex, feel free to agree or disagree.
I agree. And again, having that second degree connection or relationship always helps, and referencing common relationships and transactions and being persistent. I mean, I would add that, but I think Clint hit it right on the head.
Yeah, and just wrapping things up here, I think that's been the main takeaway, that the more that you immerse yourself in your own target sectors, and the more that you are providing meaningful information to the prospects that you're reaching, so sending out newsletters or commentaries broken down by that sector, the better response rates that you're going to get. So that's it, folks. I want to thank Clint Bundy of Bundy Group, Alex Koles of Evolve Capital Partners, and Brian Weisenberger of Ascendant Capital for joining us here today and for providing us with a great conversation. If you have questions for any of us, including myself, you can see our contact information on that last slide there. I should mention again, too, that these slides, as well as a recording of today's conversation, will be emailed out, so just look for that in your inbox. And I should mention, too, that Navitar regularly produces these types of thought leadership webinars. In fact, on September 28th, we are doing another M&A-focused webinar with our friends at ACG, which is a trade body I'm sure that many of you are familiar with. And we're going to be talking about some of the known unknown cross-border risks when you are involved in an M&A transaction. So you can go to navitargroup.com to sign up for that. Again, on behalf of our panel and Kaiten, I wish you all a fine Tuesday. Take care.